So, good day, everybody. My name is Brian LeBlanc, and this platform is Where Rebels Are. We talk about the market 4 days a week on Twitch. So, hello, YouTube. If you'd like to come join us on one of our live conversations, check out the links below and come see me on Monday, Tuesday, Thursday, and Friday, starting at 1 p.m. Eastern until 5 p.m. Eastern. That being said, today's topic that we're going to dive into is order types. What are the different types of orders you can enter? When are they applicable? And what are the risks involved with each order type? So we're going to start with the basics first, and then we're going to move on to combination order qualifiers and also bracket orders as well. If you're in Twitch today and you've got questions on a type of order that I do not cover, throw it in the chat and we'll tack that at the end of the conversation as well. So with that being said, without further ado, let's go into the first three basic order types. So the first order type is a market order. This is about as standard as it gets, and it is honestly the first order most folks enter in their portfolio. The next order type is going to be a limit order. This is the second most common, and there's two I's in limit, I-M-I-T. And this is basically essentially saying I want a specific price or better, and we're going to go into the details for that, so don't worry. And then the third order type is going to be a stop order. Okay, we're going to talk about, as we list out the order types, what they are. We're going to define it for you, as well as kind of talk about its usefulness as well as its risks. So we're going to put function, we're going to put use, we're going to put risk. And I think those are the most important factors on each of the orders. And then additional notes, if any. There may not be notes for every kind, but if we have them, we got a space to put them. So the functionality of a market order, you are basically saying buy now. Regardless of what happens. So this is going to be the first order that most people are introduced to, because when you call your broker or you do it online with your app, it's going to say, hey, you want to buy XYZ shares, and it's going to cost you this amount of money based on the current quote. A market order is the fastest order type that you can enter as a trader. It is most appropriate for day traders. Okay, if you're watching the live chart, you should have confidence that as you enter the order, you're going to get a price close to what you expect. That is not recommended for entering outside of market hours, for the fact that you can't necessarily predict the cost or the return that you would get from placing that order. Because when the markets are closed, orders pile up in the books, waiting for the market to open. When the market opens, all of those orders get submitted at the same time, and you get what's referred to as the opening cross. That's a topic for another day, but that's basically them consolidating the books and saying, hey, here's all of the orders we've got. If you have a market order, it's going to just be lumped in with whatever that average for the market cross is, and it could be, maybe $10 more expensive than you planned, or if you're buying 100 shares, it could be $1,000 more expensive than you planned. Extreme case scenario, but it does happen. So the function is acts now. Okay, so that's the most important thing to keep in mind is act now. What you're telling the broker when you enter a market order is, I just want the shares of the company that I said, regardless of cost or regardless of income if you're selling. So act now is the function for a market order, and it is only at the available price. Okay. Now, something to keep in mind, available price. All right, something to keep in mind with available pricing on your options order is that can change. Okay, like I said, if you do it during market hours closed, you could expect a pretty significant move. If you do it while the market is open, okay, let's say news just broke. Okay, you and 100 other traders caught that news and you are first to act, okay, in the group, and waiting for the thousands of other people to kind of catch up with the trade. Your small group of 100 traders, even if you're the fastest on the news, can still move the price significantly. So when you're looking at an order ticket, you've got what's known as the bid and the ask. I have another video on that, so if you'd like to look at market depth, go check that video out. But the market depth is telling us how many orders are available at each price point. Okay, if you've got 1,000 shares available at $10. And then the next one up is 1,000 shares available at $10.05. And then the next one after that is 1,000 shares available at $10.10. Your market order is going to try to act fast. But if you're not the fastest, you could get $10, $10.05, $10.10, or if you happen to be too slow, maybe even something beyond that, because you'll notice that after the first couple of bid and ask points on the chart, on the order books, they start to get more thin. So the first price point might be 1,000 shares, the next part 1,000 shares, and then the next one after that, maybe it drops drastically and there's only 50 shares available at that price, which means a lot of times market orders you'll see will get multiple price fills as well. Because if your order is, say, 2,000 shares, well, you're going to take up the first two slots, $10 and $10.05, which means your average price would be $10.02, right? Because 1,000 shares at 10, 1,000 shares at 10.05, you split the difference for your average. So a lot of people get confused when they look at their chart or their trading platform, especially if you're on a slower service that doesn't have live quotes like Robinhood or Webull, and you don't have the pro account that's giving you the live data feed. You put your order in and you get a price filled higher than what you just saw on your screen, or if you're on the phone, what your broker just quoted to you. Because when you're talking, there's a delay too. So if those are the situations that you're in and you don't like that, you can move to a limit order. Okay, but we'll get into that after the uses of market. So use cases for market order when you have a live data feed. Okay, honestly, that's my biggest advice for using market orders. Make sure you can see the live order books at least to have a better understanding of your likelihood of getting filled at the price you're expecting. All right, so you should use it with live feeds. Okay, you use it if speed is important to you. All right. And then the other use case is I don't care, right? So super long-term traders, if your time horizon is, let's say, 10 years or more, 5 years or more, in that range, or maybe even 20, there's some investors with that much of an outlook. If that's the case as well, you can enter a market order, because even if you get a ridiculous fill the day following, after 20 years, that really doesn't matter that much. You're fighting over pennies, in other words. So you use this also if you don't care about price. Okay, so those are the primary uses for the market order. Risks on market order, I think I covered that, right? You're not guaranteed price. There's no price guarantee here. Give me a second. We're going to wrap that so it's a little cleaner. We'll do this on all of them, just so I don't have to keep worrying about it. There you go. Risks, okay? No guarantee. On price only, okay? So you're guaranteed a fill, which is nice, but you're not guaranteed a fill, okay? So there's no guarantee on price. As long as you're comfortable with that, market order is going to make sense. Again, it's best for day traders or really long-term traders. The next situation is the limit order, okay? And all you're doing here is you're specifying price, okay? You're saying, I want to buy this $10 stock, but I don't want to spend more than $9.80, let's say. All right, so you're going to wait for the price to drop down to your expected purchase point. This makes sense for swing traders. This makes sense if you're on a limited budget, right? And you want to buy a specific amount of shares. So as an example, we talk about options on our channel. And if you're trading options, you need exactly 100 shares in order to write a covered call. So you would do a limit order with the intent of buying at a specific price to make sure you don't overspend your budget. Look at my options video and you'll see that I'm a big fan of cash secured puts, which kind of eliminates the need for a limit order in this scenario, but that's a whole nother story. So limit order, the function is guaranteed price. What are the risks here? Okay. The risk on this one in particular is you may not get filled. What if the stock never drops down to your $9.80 price? What if it goes 3 weeks and now it's trading at $16? Well, now you just missed out on the ride that you were anticipating that you've looked at in the chart. So you didn't get a fill. Okay. So no guarantee of fill. All right. And also, you're not guaranteed to get all of your shares as well, because you could get half your order or less. Let's say if there's a limited amount of supply when you enter your order. So if you're looking at the order book, okay, and somebody puts in an order to sell their shares for $9.80, but they only have 500 shares, your order of 1,000 shares is only going to get halfway filled because that was all that was available. Another thing that's even more likely is you will get 0 of those shares if such a small order went through, because somebody else may have had a limit order already there before you, or in some cases, they were on a fast enough data feed to enter a market order for that price. So if that's the case, you're not guaranteed a fill on it. Now, this is important for the traders. If you are watching the order flow, okay, and you see that the price goes from $10 down to $9.80 down to $9.70, the fact that a trade went below your limit price means you should, not always, but you should be due a fill there, because they would have had to skip your order if it was already on the books in order to fill someone else. Keep in mind, this is still limited by other orders that were in line ahead of you, because it's basically first come, first serve when you enter your order. The first order they have on the books is the first one that they filled. So if you've got 100 orders before you, and yours is order 101, and they run out of shares at that price before the price spikes back up, you're still not going to get a fill. But my guidance to you is call your broker, okay, or send them an email if that's your only avenue to communicate with your broker, and say, hey, I would like a time and sales review on this because I had a limit order at this price. The trade went lower. Okay. There's a few mechanics that do justify that your broker's going to have to tell you, hey, I'm sorry, there just weren't enough shares for you. Market sweep orders could be one. You should get caught up in there. But again, if the order's not big enough and your order came in late, you're not due. But it's worth checking just in case. Oftentimes your broker will go ahead and give you the fill based on their books if they have good enough service and you've got a good enough account with them. So even if there wasn't enough in the market at the time, you might still get a fill. And if there was enough in the market, then they have to count it as a trade error, and then they have to credit your account the difference. So it is worth discussing if you get failed orders there. It's just kind of a tidbit on limit orders. Don't assume that you're due a fill, but always check just in case, because if you can get it, that's great. So use is budget, right? The budget. You want to spend a specific amount, okay? So specific price is your driver here. Budget specific, I should put price. All right, that's it for limit orders. I think that's pretty straightforward. And you can do it again on the reverse side. I'm using buy orders as my primary example, but for a sell, if you already owe the shares, it's currently trading at $10, you can put a limit and say, hey, I want to sell at $11. I'm going to put some order qualifiers after this conversation so that you guys have a little bit more clarity on how to better use these orders. But just know that even when you put in an order as a limit or a stop, it doesn't have to be just for the day like market orders are. You can extend those two orders until good till canceled, but we'll talk about that in a minute. Next is the stop order. This is probably the most confusing basic order for most people. The reason is because you're putting a trigger point on the order, okay? You are not guaranteeing price. You are saying, if this event happens, I want to trigger a market order. So trigger market order. Okay. This is probably the most useful type of trade for folks who are swing trading. Okay. And you're looking for a specific technical event to happen that you've identified on the chart. So what am I talking about? If you've got ABC, we're going to go back to our same example of a $10 stock, and you think that once the price gets up to a certain point, it's going to continue to run further. So you're watching it, you look at the chart and you're like, you know what? I've identified a breakout point at 1050. If that happens, I want to get in and I want to be involved. So that's going to trigger a market order at that point And you're going to get either 1050 or 1055 or 1045 or, maybe even $11 if things went really, really fast. This is a dangerous order to leave overnight because, again, the gap situation that we talked about on the market, you don't know that you're going to hit your price specifically. Okay, so your stop order triggers at or above any price you set it. And I'm talking specifically about stop buys. These are not common. I'm going to tell you the most common way for a stop order in a second, but that's how a stop buy works. You trigger at 1050, you get the fill of whatever the next order is. So if the market closes and it closes at 1010, let's say, and then the next day the market opens at $11, your order has officially triggered. But the aspect of it jumping up to $11, well, your stop price, your trigger, was $10.50. Okay, $11 is above your trigger. You didn't put any other qualifiers there. You're gonna get filled at $11, $11.05, $11.50, whatever's available. You're not guaranteed price. So the use is to use for breakouts. Okay, both on the upside and the downside. Okay, and we'll talk about the most common way to use a stop in a second. But it's used for breakouts. It is a trigger price. Okay, and this is important to remember. And the risk here is, again, no guarantee on price. There we go. No guarantee of price. The other thing is you also, on this one, have no guarantee of fill, right? If your trigger is never there, then it won't happen, okay? Or fill. So this one has the risks of both of the previous two orders here. Now, most people, when they get introduced to stop orders, it's referred to as a sell stop order, okay? So in this example of buying your stock, let's say you bought it at the $10 mark, okay? But you want to protect your investment because you're worried about it. A lot of brokers, especially young brokers, will say, hey, maybe you should consider using a stop order because what this allows you to do is, because there's no guarantee of fill, you get to hold your shares as long as they continue moving in the direction that you want them to, which is up. So you buy at 10, you put a stop order under $10 and you put it at, let's say, $9.50. What's going to happen is that order is going to sit on the books if you do it as good till canceled, which we'll get into qualifiers in a second, so don't worry. Good till canceled. And it's going to sit on the books until the price drops down or until the order expires. If the price keeps going up, the order is going to expire. Maybe you re-review the position, add a new stop at that point. But that's where most brokers are going to tell you to use it. The risk, okay? A lot of people think that stop loss means stop losing money. That's not always the thing, okay? There's two scenarios that came up very frequently in my years as a broker. Scenario one, you've got your stop loss at $9.50, okay? The very next day, it opens at $9.50. You get filled at $9.25 because the opening cross, there were a lot of orders ahead of you. That was all that you could get because, again, remember, you're triggering a market order, not a limit, which means $9.50 is the price that triggers, but the price that becomes available next is the price you get. So a client will call up and they'll say, hey, I placed a stop order for $9.50. I got filled at $9.25. What's the deal? Well, sir, the deal is, or ma'am, the deal is that there weren't enough shares at $9.50. We could only give you $9.25. All right, that happens quite often. The next scenario, and then this one was really hard to kind of walk people through, is really bad news comes out, right? And the first 5 minutes of the day, the stock's now trading at $9. Bam, $9. Ouch, right? That's well past your trigger of $9.50, so it does trigger an order. You're lucky, you get filled at this $9 opening price. Great, okay, all things are fine. You stopped losing money. But then 5 minutes later, the market skyrockets back up to $10.50 and you're already out of the position, okay? That's a risk you run with the stop loss order on your trade. You got filled, okay? You're triggered $9.50. Your fill, $9, because that's where the market started. But then the market recovers and you're out of the position. So That kind of happens. It's a whipsaw. It happens a lot in the market, especially now with the volatility where it is. I'm sure that this is a very, very common situation that my past colleagues are all having conversations with their clients on a regular basis. But it's the reality of the stop order. So if you don't understand and you're not comfortable with those risks, don't use a stop order. That's really kind of my guide on it, because most people think about the stop order as a protection when you're talking about a sell stop, and they assume that it's almost always going to be a favorable situation. But oftentimes it's not. All right, so we're going to move on to qualifiers, because I've talked about good till canceled a couple of times, as well as talked about day orders. So we're going to talk about the qualifiers that you can put on your orders. So what is an order qualifier? This is an additional caveat that you can share with your broker. And most trading platforms are going to allow you to push the radials or drop downs to select these options. The first one is day. Okay. The function of this is, well, only good for a day. Only good for the day you put it, or the next day. A day. Okay. So a day order means you're telling your broker, if this condition is not met tomorrow, I want you to just cancel the order because I'm not interested anymore. It makes sense for people who are very frequent and active in the market. If you're a day trader, then obviously you don't want to wait to try to trade a setup tomorrow. So you better be using a day order. And then it's also good for people who don't have the time to babysit the market. So end of your day, you notice the order, you tell your broker, hey, I want to place this order for tomorrow. Good thing. Or maybe on the weekend you say, hey, Friday's over. Let me look at my stocks. Oh, hey, I'm interested in this on Monday. Let's put an order for Monday. So day orders is the default for most order situations. I don't think I've ever run into a broker that defaults to good till canceled. And if they do, they've probably got a lot of problems on their hands. But a day order is, again, just saying, hey, this order is good for either today, the day I entered it, if the market's open, or tomorrow, if the market's closed. So that's what it's used for. Pretty straightforward. I'm not going to worry about risks for qualifiers right now. Good till, well, not for day orders. I am going to for good till canceled. So you've got good till canceled. Canceled. This is the next most common order qualifier. And we're going to put GTC here, because that's where you're going to see it denoted on most online talks or conversations. What this is it's good for 60 calendar days. Most firms. That's the standard in the industry. You might find a broker that lowers that to 30 days because of volatile conditions. You might find a broker that says, hey, our platform will let you keep this on for 6 months. We don't care. Regardless, the standard is about 60 days, but it literally is what it says. This means the order stays on the books until it's filled or canceled. Well, I should say filled, canceled, or expired. Filled, canceled, or expired. All right. So that's a good thing. Make sure you understand your broker's trading rules and their operations, because again, the standard for the industry is 60 calendar days. Some will be more conservative. Some will give you more leeway. And then some will have multiple options, right? I think Interactive Broker allowed you to choose 60 days or 6 months. For some reason that sticks in my head. I don't know if it's accurate today. But there are some brokers that will allow you to extend that out. And you're going to use this good till canceled most often on limit orders. Okay. And then again, a lot of people will use it when you're using it as a sell stop order, right? On the sell side. Very few people will put a good till canceled on a buy stop. You can do a buy stop if you've got a short position as well, to protect the same way that you would expect to try to protect a long position using a sell stop. But again, we talked about the risks for sell stops. It's riddled with complexity, and you may not want to just leave it there. Okay. So anyways, good till canceled. Use is when you don't have time to babysit. Don't have time to monitor. because that's more professional. And that's a use, okay? Risks, again, on the good till canceled, there's still no guarantees here, okay? No guarantee, because it's, again, all of your orders are based on the underlying stock price. No order that you put in can control the outcome of where the stock is going. So just keep in mind with that aspect. The next qualifier that you can use. A lot of people don't know that these are available. These are qualifiers that will not be available at all brokerages, but you can still ask, fill or kill. What do you know? Filthy Cash guessed it. Fill or kill. Okay, the FOK order. What this is basically saying, give me what I asked for right now, or don't do it at all. So this is a good qualifier to put on if you've got a market order that's in a market that's moving really fast and you're concerned about getting an appropriate fill. Okay. Also, could be used to, if you suspect that a stock is nearing a market halt situation and you don't want to get in before the halt triggers. Okay. You could do fill or kill as well. Because if the stop triggers or the stock moves too fast, you won't get filled and then you avoid the market stop. Fill or kill was super popular for a little while. It's much less popular now because, again, we have live data feeds. So you can watch the order yourself and say, hey, I threw it out there. It's been a minute. It's still not filling. I'll cancel it myself. Yeah, it's a day trader thing. Right, exactly. So most people with live data feeds don't use fill or kill anymore. And again, it's only really helpful in hyper fast or hyper volatile market situations. And again, as a day trader, I got to say this, your best advantage is speed, how nimble you can be. So the more qualifiers you add, okay, and I think this is an appropriate time to add this note. The more qualifiers you add, the less likely your order is to fill. Every time you give an additional instruction, it slows down your order process. So the way that order flows with most brokerages work is they get the data, they send it to the market, and the market maker reviews and executes as possible. Most all of that process is completely automated. Every once in a while, you can end up seeing a situation where your particular trades or orders get audited. That's called boating. It is required from FINRA standpoint. So you could win the lucky number lottery and they decided to review your order out of their entire order flow. And it sits in a queue till somebody can look at it and then approve that it can continue to move forward. That's a mechanism to ensure stability in the markets as well as stability in systems, because it does help them identify when things are going wrong. It sucks to be the trader on the opposite end of that, boating. I've been there more than once in my career, but it's a necessary evil. It's not going to happen to everybody, and it's not going to happen every day, right? I've been trading for 20 years. I've been boated twice. Both times I got pissed, but it happens. So if you're adding qualifiers, you also increase the likelihood of your order getting picked because the more complicated orders have problems more often. So of course, those are going to be the ones that they want to audit. The next thing is the time it takes you to enter these qualifiers slows down how quickly you can submit your order. Okay, which means you are further behind in line than everybody else who just entered a standard order type. And then again, the algorithms take more time to process each of the complications that you add to your order. So all of these things should be considered when you're adding qualifiers like fill or kill and some of the next ones we're getting to. Fill or kill, its function is to give me the order now or not at all. Oops, there's a T there. Use is when you're worried about volatile markets or volatile or fast markets. And then the risk here is you are slowing down your order, and then of course you might not get filled because it might not be immediately available. So given a fly, fill or kill expires in minutes. So it's actually faster expiration than a day order. fill or kill, depending on your broker, usually has a once the order is live and on the books, an expiration of just under a minute. And fill also, I can't skip over this, has the qualifier, give me, I should say, the full order, because you don't want a partial, because there's another one you can do for that. So give me the full order now or not at all. So this is also going to be an additional, this is technically two qualifiers. It's a time qualifier and a size qualifier. So they also have the next two options, which break down your size. So minimum, and you have all or none, none, and then immediate or cancel. So just like fill or kill, you've got the ability to qualify either just time or just the number of shares. So minimum quantity, if you've got 1,000 shares, you can say, hey, give me at least 500 or I don't want the order. So that's pretty self-explanatory. All or none means give me the full order or nothing at all. Full shares only. Okay. Again, for covered options writers, this one might be one that you want to consider, right? Because you can't write shares on a fractional position. Has to be contracts. You can't write options contracts on a non-round lot, so at least 100 shares. And then this is a time qualifier. Right now or not at all. Okay. Again, each of these risks, it's slowing down your order. Okay. And each of these risks mean that you're not guaranteeing a fill either. Because let's say in the minimum quantity situation, if you said, I don't want this order if I can't get at least 500 shares, but there were 300 available, you kind of shot yourself in the foot because those 300 shares still could have had value to you. The next thing is all or none. Again, you're limiting the qualifier on this order. So if I don't get my full 1,000 lot, I'm not going to be there. Something to keep in mind with minimum quantity and all or none. If the order book shows that there is 1,000 shares available for your 1,000 share order, but they're on two separate exchanges, you also run the risk of not getting a fill. So if you've got 500 shares on the New York exchange and 500 shares on the the Felix network. So the Philly network. So if they're two separate ones and one of those two gets filled faster than the algorithm can connect your order, it's going to cancel your order. Because, well, it's not going to fill your order, I should say. It's not going to cancel. It's going to not fill your order because it just wasn't fast enough to connect the dots. So you're limiting yourself in that way as well, because the connection of these two 500 shares either takes manual intervention or an algorithm that's fast enough to connect to both networks before one of the two has a fill. So those are important things to identify on this order. Because these qualifiers, again, limit the possibility or probability of getting an order filled. Now, if you're wanting any of these specific outcomes, they're still useful. Real quick question for the group. Any of you guys have any other qualifiers that I missed? I think those are all of the standard qualifiers. But I want to know if anybody's got one they want me to include on this list. No? All right. The next section, this is going to be combo orders. All right. So you can combine multiple order types. Okay. Market is market. No combination there. But you can do combo orders and brackets. All right. Not all brokers have this available. Again, so check with your broker, see if it's available. But combo orders, the first one we're going to talk about is a stop and a limit. All right. So stop, limit, order. Okay. A stop limit is combining the trigger feature with the minimum price requirement feature. That's a good question, Zai. Well, I don't know. I mean, somebody else might be interested in it too if you find it. But the question is, are there any platforms out there that offer fill or kill qualifiers for crypto traders. So the risks, I scrolled back up here because the risk for the stop, right? You have two different risks here. There's no guarantee on price and there's no guarantee on fill for the trigger. So you can remove one of those risks by combining a stop and a limit together. So a stop limit starts with a trigger, but it triggers to a limit, but activates order. Okay. Now, in terms of the trigger activating a limit, this is used when you want to have the function of the stop of a stop, but get a guarantee on price. Okay, this is a quick note, but I did have this conversation in my career, believe it or not, more than once. I had people call and get mad because they got a better price than expected on a stop limit. In other words, they put the stop in there, and let's say the stop was $9.50, and then they have the qualifying limit of $9.40. Right? So their limit is 40 cents. They call up and they're like, I got to fill at $9.55. What the hell? Yes, or better. So better than the price that you put in to project. It happens, not frequently, but it does. And so just understand that you could get a better price than what you expected. So it's not when brokers tell you it's guaranteeing you a price, that is insinuating the price that you want or more favorable to you. So a favorable price can still trigger. And you'll see why they get upset at the more favorable price on the functionality of a stop limit here in a second, because there's some risks that happen in a stop limit order. So you're in the situation, and we're using the sell in this example, just so everybody's on the same page. You bought the stock at $10. Okay, you put a stop loss limit order in there, and you say the stop trigger is $9.50. Okay, whenever you have a stop trigger, you have to put the limit at the same price as the trigger or lower. Okay, so the lower price would be $9.40 as the example. So in the market, okay, fast market, it opens up in the morning, it opens at $9.50. Okay, that triggers your stop order. Drops down for a quick second and then spikes back up. Your limit of $9.40 is your minimum price, could be triggered, and it could come in at $9.55, which is above your stop, but your stop's still technically triggered. And because of that, you get the fill. That upsets people. And I have to say, hey, this is the way the order works. You shouldn't be complaining because you got a better fill. And you still got a better fill than if you had actually placed a stop, because that trigger at $9.50 could have dropped down to like $9.45, and that could have been what you filled at if it was a market order. But because it had to trigger into a limit order, it takes just a little bit longer. You got a better fill because by the time your order got recognized, it moved up a bit. So understand that that's a thing that happens on stop limit orders. Okay, but the risk here still is no guarantee, okay? And the price will potentially, and here's the other risk, not be available or move back above your stop. That's a long note, but whenever I had the conversation with folks on entering stop limit orders, this was my longest conversation with them. So the other risk that I just wrote down there is your price might not be available. So if your stop is $9.50, okay, and your limit is $9.40, what happens if the stock price drops down to $9.20? And I want this one answered from chat. It didn't fill. Right? Because now you have to wait for the stock to tick up from $9.20 back up to $9.40. Okay? So that is another risk on the stop limit. Exactly. You guys got it. Perfect. All right, so that's the stop limit. Bracket orders, okay, this is a condition in which some brokers will allow you to enter a buy order with an immediate sell contingency. So bracket orders, okay, and you'll want to talk with your broker on this if you haven't used it before, but bracket orders allow for sell contingencies, I will use, at the time of entering the buy. Bracket orders, okay, are used, okay, oftentimes for brokers because there was a situation where somebody would call and they'd say, hey, I'd like to place a buy order, a limit buy order for ABC as an example. Right? Well, we don't know how long it's going to take that limit order to fill, and neither does the client. The client doesn't want to keep babysitting his account, and so also wants to add an exit strategy, either a sell stop or an upper limit to maybe sell at a better price, a more favorable price. So this allows you, this is the only order type that will allow you, unless you've got some other black box or API access that allows you to do this kind of stuff. But some brokers have implemented bracket orders. Now, the contingency here is when you use bracket orders, a lot of people don't realize this, but the bracket order itself is now sitting on your broker's server. Okay, it's not actually fed through to the rest of the market, which means it's on your broker's ability to connect that trade when they see that it's available. So basically, when the contingency for the limit comes up, if they see that it's available, they will then send out to the broad market, hey, our client has a limit order at this price. Let's try to get a fill. So it does slow down your order execution and mean that you're further back in line, again, from everybody else in order to get fills if there's a thin market. So if there were only 10,000 shares available at your limit price, this particular order means that you're going to be on the lowest level of priority for getting a fill. You're last in line because the broker can't keep your buy order sitting there in contingency necessarily as a live order until it becomes available to fill, because you have an additional caveat saying you immediately want to switch over to a sell order. So in order to get around the market restrictions for data flow, brokers house these order types on their own books and just stay connected to the market and fill you on a best efforts basis. So you are the slowest order, which means if things are happening exactly at your price target, you're not guaranteed to fill on this one. The next thing is once the order does actually fill, you've got the buy, they're still maintaining the sell order again on their books or on their infrastructure, their background, whatever data center they have, until the market conditions meet what you have on their server. And then again, they'll present it on a best efforts basis. So this is the slowest order type, but it's perfect for people who don't want to sit around and babysit their account all day. Because what's happening is you're saying, hey, I want to enter a buy order on ABC, and the limit is $9.80. All right. But I also want you to keep in mind that I want an immediate sell order limit on there to sell it if it gets up to $10.50 or better. So it's good in that aspect, but it does risk. This is one of the slowest order types. Okay. Now, this isn't always going to be like super pertinent to everybody because there's a lot of liquidity in the market over the last year and a half. But as the active day traders start to dissipate and more activity moves back into the fixed income side of the investing world, you will see that the market volume starts to slow down. This might become a challenge or a risk again. As of right now, what are we, October 2021? It's still most stocks that you look at are going to have pretty good volume, except for the pennies, but y'all penny traders already know that that's kind of the name of the game. So that's all I got for the order types at this point. We got the combos / brackets. We got the basic types. We got the qualifiers. Did I miss anything on the order conversation that anybody in the community wants to go over? Well, it looks like everybody on Twitch is on board or on the same page here. For those of you guys watching this on the rebroadcast for YouTube, thank you for your time. My name is Brian LeBlanc. This platform is Where Rebels Are, and we stream again 4 days a week, Monday, Tuesday, Thursday, and Friday. Come join us on Twitch if you want to participate in the conversation live. Otherwise, throw your comments and questions below. If I missed a particular order type or qualifier that you want a little bit more explanation on, I will be happy to answer your comments and the questions. That being said, YouTube's probably my slowest comment response rate out there across social media. You can join us in the Discord as well. That will be linked below. Otherwise, I will see you on the next video. Don't forget to like, subscribe, and share this with your friends if you got anybody else who's trading and would like this information. Until next time, be known for what you stand for, Rebels.